Joining us to break down the markets this morning, Trivariate Research CEO and CNBC contributor Adam Parker is with us here at Post 9. It's good to see you, AP.
Thanks, Trev.
Steve's got a great point. And then this decoupling of equities from the rate environment, is that all because of Mag 7 or something else?
You know, I was just sitting there watching, thinking, I kind of am partially responsible years ago for starting this garbage of like good news is bad and bad news is good when I used to work at Morgan Stanley. And I was sitting here thinking, you know what it is? It's just good news is good news and bad is bad. That's where we are now. You get bad economic news, I think the market's going to go lower. I think if you get good news, we continue to do well. And it's no longer just all about, expectations for interest rates a year from now. We're in this pocket where if we get continued decent economic news, we don't think things are falling off a cliff, I think equities look pretty good. So we're in the normal, God forbid, good news is good for markets and bad is bad. Maybe that's where we are. I know that what doesn't work is good economic news is bad for markets for a long time. I get how you get a little hawkish, you get worried. That's always a two-day thing. So that's kind of where my head was watching that. Is like, maybe we're just like good news is going to be pretty good.
So does that require kind of a decoupling of the way we think about interest rates and the interplay and what it means for corporate America? Because obviously with higher for longer interest rates, that means higher financing costs and, it affects discounted cash flows out into the future. So, with cost of capital where it is, how is it that the market can kind of reverse its thinking on that?
So two thoughts. One is, I think that thinking is very recent, like the last year or two. Back 100 years ago when I was in school, I thought what I learned is if the economy's good, the 10-year yield backs up and the stock market goes up because they're both representative of things improving. That's actually really where the baseline is. We've gotten this whole like Fed-induced, all that matters is the Fed thing that's kind of made your point where everyone's mind is the last couple of years. So I think the second thing is I focus on the biggest 500 companies or so, in the U.S. And this will be dismissive. I'm sure I'll get some commentary, but basically the S&P 500 companies don't go bankrupt. Okay, they both basically. Okay, one or two every few. So they have high quality balance sheets. The cost of capital, which you talk about, is really more for profitless businesses in biotech, refinancing the capital markets activity. It's not really when you look at the biggest 100 companies that continue to do well. So that's kind of my two thoughts on what you said. And then in the setup of the show, what I thought was interesting is just the magnitude of the moves you talked about on earnings, right? Where, how much these stocks are up. You didn't mention, I think, Melly, that thing's down. It's like there's just big moves going on underneath. So I'm kind of tired of people whining about all that matters is the Mag 7 and that's all I have to get right. No, there's tons of alpha stuff going on, as you point out in some of the names you went through. So there's some stuff going on.
But are you saying that the Russell is outside of your realm of interest?
No, it's just that it doesn't work unless you think gross margins are going up for the average company. To say that you like small caps means you're very bullish. You think that it's a risk-on trade that happened in November. Why? Because financial conditions eased, and that's all that mattered. Now, for you to believe that we have this broadening rally and everything's awesome, you're bullish and you think margins are going up for lots of companies and their estimates are going up more than Mag 7.
But you've written recently that you think margins arguably have bottomed.
I think they have bottomed, and that's why I'm bullish on a lot of things. But I think you have to own the Mag 7. I don't see how you can take the risk of being underweight that group unless you're wildly bullish.
What about just the broader macro conditions here? I mean, you've basically said a soft landing kind of coming into view here. Is that more dependent, perhaps, than what we're getting out of the Fed with regard to maybe preemptive rate cuts or something like that?
It's funny. Like, if you go to Trivariate's website, you search on Powell, it says 0 search results. Why? Because I have no clue. Okay, I've worked with really smart people at big firms, and they're not good at it either. It's just really hard and unknowable. And so I think that's why I focus more on the corporate earnings and the big companies. And I look at the big names and their numbers. The biggest 20 U.S. equities, the earnings numbers are up a lot, and that's why I want exposure to it. But the answer to your question is I think it's mixed. Okay, I think economic activity looks like it could be bottoming. LEIs are maybe a little bit better. But the consumer's slowing, and it's in good but declining position. And I think maybe industrial activity could be bottoming when I piece it all together, whatever the couple hundred variables we look at, it's okay but declining. That's how I'd summarize the economy. But corporate earnings can be a lot better than the economy for all the reasons we talked about. Those companies that you go through, they have power. They have pricing power. They have cost controls. They have moats on their technology. They grow their net income 15% plus a year pretty consistently. So the reason I'm always bullish on U.S. equities, and I don't like when people say they like EM or they like bonds, is get me exposure to the best 20 U.S. equities. Get me something better than that 15% per year growth. So that's been more or less the broken record for the last 10 plus years, I guess.